In 2019, one company was worth $47 billion. It owned almost no real estate. It had never made a profit. It was losing millions of dollars every single day. And yet some of the world's smartest investors believed it could become more valuable than companies that had spent decades building real businesses. Its name was WeWork. To the public, WeWork looked like a technology company that was reinventing the future of work. Its offices appeared modern. Its events felt exclusive. Its founders spoke about changing the world. Investors weren't just buying office space. They were buying a vision where people wouldn't simply rent desks. They would join a global community, a movement. A company that claimed it wasn't in the real estate business at all, but in the business of human connection. Wall Street loved the story. Venture capital firms competed to invest. Money poured in faster than the company could spend it. Every funding round pushed the valuation even higher. $10 billion, $20 billion, $30 billion. Until one startup that leased office buildings was suddenly worth $47 billion. More than many of the world's oldest and most profitable corporations. It looked unstoppable. But behind the glass walls, the expensive parties, and the inspirational speeches, the business was hiding a problem so obvious that once investors finally saw it, the entire empire began collapsing in a matter of weeks. This is the story of how one startup burned through billions of dollars and fooled Wall Street, and became one of the greatest corporate collapses in modern history. Long before WeWork became one of the world's most valuable startups, there was just one man with an impossible dream. His name was Adam Neumann. He was born in Israel. Neumann moved to New York with enormous ambition. He wasn't an engineer, wasn't a software developer. He wasn't a real estate expert, but he had something many founders never do. It's an extraordinary ability to convince people to believe. In 2010, Adam Neumann and Miguel McKelvey launched WeWork. The idea sounded simple. Rent large office buildings, redesign them into modern workspaces, and then rent smaller offices and desks to freelancers, startups, and growing businesses. At first, it looked like a smart real estate business. Companies no longer needed expensive long-term leases. Freelancers gained professional office space. Startups could expand without committing to huge buildings. Everyone seemed to win. But Adam Neumann refused to describe WeWork as a real estate company, insisted it was something much bigger. We don't rent offices. We create community. That message changed everything. Investors weren't comparing WeWork to landlords anymore. They were comparing it to Silicon Valley technology companies. And technology companies received far higher valuations. The more Adam spoke, the bigger the dream became. His presentations weren't about desks. They were about changing how people lived, worked, connected with one another. Investors weren't just funding office buildings anymore. They were funding a vision of the future, and soon, one investor would hear that vision and make a decision that changed WeWork forever. By 2014, WeWork was growing faster than almost anyone had expected. New offices were opening across New York, then San Francisco, London, Shanghai, and Tokyo. The company wasn't just leasing buildings anymore. It was expanding across the world. But there was one problem. Growth like this was incredibly expensive. Every new location required millions of dollars before a single customer walked through the door. WeWork signed long-term leases that often lasted 10 to 20 years. Then it rented those spaces back to customers on flexible monthly contracts. If businesses stopped renting, WeWork still had to pay the landlord. The business looked modern, but underneath it carried enormous financial risk. To keep expanding, WeWork needed billions of dollars. That's when Adam Neumann met one of the most powerful investors in the world, Masayoshi Son, the founder and CEO of SoftBank. Son had already built a reputation for making some of the largest technology investments in history. He believed the future belonged to companies willing to grow faster than everyone else. When Adam pitched WeWork, he didn't show him a real estate company. He described a global platform that would transform how humanity worked, according to multiple accounts. Their first meeting lasted less than an hour. By the time it ended, Masayoshi's son wanted in. Over the next few years, SoftBank invested more than $16 billion into WeWork through direct investments and commitments. It became one of the largest startup investments ever made. With billions flowing into its bank account, WeWork stopped thinking like a fast-growing startup. It started behaving like a company with unlimited money, and that would become the beginning of its downfall. With SoftBank's money behind it, WeWork entered a completely different world. The company was no longer trying to prove it could survive. It was trying to become unstoppable. New locations appeared everywhere. The company expanded into dozens of cities. Employees were told they were building the future of work. Investors believed they were watching the next great technology company being created. But there was a dangerous problem. The numbers didn't match the story. Behind the futuristic offices and motivational speeches, WeWork was still a company paying billions of dollars to lease physical buildings. And those buildings came with fixed costs. Every month, rent had to be paid. Every employee had to be paid. Every new location needed more investment. The faster WeWork grew, the more money it needed. Between 2016 and 2018, the company lost billions of dollars while continuing its aggressive expansion. But instead of slowing down, WeWork accelerated. The company began entering businesses far beyond co-working spaces. It invested in residential housing, created education programs. It explored new technology ventures. It even changed its legal name from WeWork to the We Company in 2019. The message was clear. This was no longer just an office company. It was supposed to become a global ecosystem that would change how people lived. But there was one question becoming harder to ignore. Could a company lose billions every year and still become one of the most valuable startups? For a while, investors believed the answer was yes, because Silicon Valley had a powerful idea. Growth mattered more than profit. And WeWork became one of the greatest examples of that belief, till the company decided to do the one thing that would expose everything: go public. For years, WeWork existed inside a world where private investors controlled the story. As long as new funding kept arriving, questions about profitability could be ignored. But in 2019, that changed. WeWork announced it was going public. An IPO would allow ordinary investors to buy shares of the company. It was supposed to be the final proof that WeWork wasn't just a startup, but a global technology giant. The company prepared a document called an S-1 filing. This document revealed the truth behind the business. And Wall Street started asking questions. The biggest problem was simple. WeWork was losing enormous amounts of money. In the first half of 2019 alone, the company reported a loss of more than $900 million. Yet the company continued presenting itself as a technology platform. Investors wanted to know, if WeWork was a tech company, why did its business model look like a real estate company? Why was it signing expensive long-term leases, while customers could leave with short-term agreements? And then, more details began to attract attention. The S-1 filing revealed unusual corporate governance issues. Adam Neumann had significant control over the company. There were concerns about conflicts of interest. Investors discovered that Neumann had sold millions of dollars worth of shares while still leading the company. The dream was beginning to collide with reality. The same document that was supposed to launch WeWork into the public markets started destroying the image it had built. A company once valued at $47 billion was suddenly being questioned by the entire world, and the countdown to collapse had begun. The reaction was immediate. Investors who had once competed to fund WeWork were now trying to understand how they had missed so many warning signs. Analysts began dissecting every page of the S-1 filing. The questions kept getting worse. Why had Adam Neumann personally bought buildings and then leased some of them back to WeWork? Why did the company pay millions for the rights to use the word "we" from an entity controlled by its own founder? Why did one person hold so much voting power over a company asking the public for billions of dollars? The deeper investors looked, the more confidence disappeared. Within weeks, the expected valuation collapsed. From $47 billion to around $20 billion, and lower. Some analysts argued the company was worth less than $10 billion. The IPO that was supposed to make history was falling apart before it even happened. Inside the company, panic spread quickly. Employees who had been promised life-changing stock options watched their future disappear. Expansion plans were frozen. Hiring slowed. Confidence vanished. Then came the decision no one had expected. In September 2019, WeWork officially postponed its IPO. Just days later, Adam Neumann resigned as CEO under intense pressure from the board and investors. The founder who had convinced the world he could reinvent work was suddenly gone. But removing the founder didn't solve the problem. Because the real crisis was no longer about Adam Neumann. It was about a business that was burning cash faster than almost any company in Silicon Valley history. And someone would have to decide whether WeWork was still worth saving. By the end of 2019, WeWork was running out of time. The IPO had failed. Its valuation had collapsed. Investors had lost confidence. The company was burning through cash at an alarming rate. Without new funding, WeWork faced a very real possibility of running out of money within weeks. The company that had promised to reinvent work was now fighting for survival. Only one investor had both the money and the incentive to keep it alive: SoftBank. By this point, SoftBank had already invested billions of dollars into WeWork. If the company failed completely, one of the largest venture capital bets in history would become an enormous loss. Masayoshi Son had a choice: walk away or spend even more money trying to save the company. He chose the second option. In October 2019, SoftBank announced a massive rescue package worth roughly $9.5 billion. The rescue gave SoftBank effective control over WeWork, but it came at a huge cost. Adam Neumann agreed to step away from the company. He left with an exit package reportedly worth more than $1 billion, including payments, financing, and the purchase of shares by SoftBank. The decision sparked global outrage. Employees had watched their stock options become almost worthless. Thousands feared for their jobs. Yet the founder responsible for the company's collapse walked away extraordinarily wealthy. For many observers, it became the perfect symbol of the startup boom. Privatized rewards, socialized losses. But even after billions more dollars, WeWork's problems hadn't disappeared. Because no amount of investment could fix a business model that investors no longer believed in. The hardest decisions were still ahead. SoftBank's rescue bought WeWork something priceless: time. But it didn't solve the company's biggest problem. Its business model still depended on signing expensive long-term leases. While relying on customers who could leave at almost any time, the company spent the next few years closing locations, cutting thousands of jobs, selling businesses, and trying to reduce billions of dollars in lease obligations. Then, another crisis arrived. In 2020, the COVID-19 pandemic emptied office buildings around the world. Remote work became the new normal. Companies no longer needed large office spaces. The very future WeWork had promised changed overnight. Although demand gradually recovered in some markets, the company never regained the momentum it once had. In October 2021, WeWork finally became a publicly traded company through a SPAC merger. But it wasn't the triumphant IPO Adam Neumann had imagined. The company entered the public market at a valuation that was only a fraction of its former peak. The dream had already faded. Losses continued. Debt remained high, occupancy struggled, confidence never fully returned. Then, on November 6, 2023, WeWork officially filed for Chapter 11 bankruptcy protection in the United States. Just 4 years earlier, it had been one of the most valuable startups on Earth. Now, it was fighting simply to survive. WeWork wasn't destroyed by one bad office or one failed building. It was destroyed by a boardroom that believed growth alone could replace sustainability. Investors chased a story instead of a business model. Executives chased valuation instead of profitability. And when reality finally arrived, the numbers spoke louder than the vision ever could. Thank you for watching Boardroom Files. Subscribe for more stories about the biggest boardroom decisions that changed the world's most powerful companies. Because behind every billion-dollar company, there is always one decision that changes everything.